Next on stage, Global Treasury Perspectives on Asset Management and Liquidity Optimization. Moderating the discussion, Konstantinos Andritsopoulos, Head of Treasury at Volton Energy. Joining him on stage, Andreas Papanagiotopoulos, Group Treasurer at Ellaktor. Daniele Curci, Head of Investment Specialists and Business Development at Amundi. Mark Bellward, EMEA Head of Liquidity and Margin Services at BNY, and Yannis Pantoleon, Group CFO at Olympia Group of Companies. Please welcome our moderator and speakers to the stage.
Hello all of you, finally. So, good afternoon, ladies and gentlemen. With pleasure, I welcome you to today's panel with title Global Treasury Perspective on Asset Management and Liquidity Optimization. In today's rapidly evolving environment, liquidity has swift been a purely operational necessity to a strategic lever of corporate finance. We have rising volatility on interest rates, we have geopolitical uncertainty globally, and market dislocation that reshaped how treasurers, corporates, how asset managers, and how banks must approach the balance between security, yield, and flexibility. I'm going to take you 5 years, which in the era of COVID and after, we saw, and as all today's session, we saw the volatility that we have into the markets. We saw the geopolitical uncertainty that we had. And due to that, in 2025, I cannot count how many uncertainty, geopolitical-wise, we had. So the question right now is no longer whether to hold the liquidity that the companies have, but rather how best we can deploy it as corporates in a way that we can enhance both corporate finance and financial performances. So I'm privileged to introduce you to our distinguished group of panelists who brings complementary perspectives from the corporate, Yannis and Andreas, and from the asset management world from Mark and Daniele. I welcome all of you, I'm starting from my right, Mr. Daniele Curci, which is a Head of Investment Specialist and Business Development at Amundi. Hello, Daniele. Next to him, Mark Bellward, which is Head of Liquidity and Margin Services at Bank of New York, BNY. Next to him, we have Mr. Yannis Pantoleon, Group CFO at Olympia Group of Companies. Hello, Yannis. And last, we have Andreas Papanagiotopoulos, Group Treasurer at Ellaktor. I'll welcome all of you today. So basically, this panel will span the full spectrum from a corporate treasury to execution and from investment management to banking infrastructure. We have focused into the 5 themes of our panel, which it's going to be a discussion more than a panel with question and answers. And I'm starting from the corporate side, and you, Yannis, how has the role of liquidity strategy evolved in the past years, and in terms of market volatility and interest rate uncertainty?
Listen, the truth is that during the last 4 or 5 years, we have seen a fluctuation in the rates. I mean, it used to be 0 or even negative before 2020. Then they started after COVID, let's say, going up. They stabilized for a couple of years to 4.5% at euro level for the euro area, 5.5 for USD, and then they started coming down. Obviously, it was a move that I would say, at least to my view, it was somehow predictable, although you could not, let's say, exact much where it could, let's say, the rates could land. So, let's say, the last, let's say, 2-3 years, I think it was obvious also in the asset management world that one should lock, let's say, excess liquidity and, let's say, do proper asset management by locking, let's say, yields for the longer run because of the expectation that the rates could go down. Now that we are, let's say, somehow, at least at the rates at the Eurozone, let's say, more or less at somewhere that, let's say, the market predicts that they will not go, let's say, significantly down, or even they go up. I mean, the market, let's say, prices that go up. Then there is a question what you do. Here, I think that, let's say, asset management provides significant or some interesting tools. Let's say, you can, let's say, buy or sell the volatility because markets are not only, let's say, let's say, at a low rate level, but they are quite volatile because also of geopolitical, let's say, issues. The new U.S. government that has, let's say, disrupt, let's say, the global environment. So there is volatility. Volatility offers significant opportunities, let's say, to lock yields or enhance yields. At the same time, you can, for example, buy longer, let's say, term assets, and let's say returns are a bit higher. Or even you can take some opportunity to leverage your position as the rates are low, and let's say have a carry trade on your let's say sort of treasury position.
Okay. From your perspective, Andreas, from corporate perspective into treasury, and I'm showing the graph behind you that you sent us. What is the answer of the volatile environment?
First of all, thank you for you and Hat for the invitation. Indeed, as Yannis mentioned, after the end of the zero rates regime, we have been experiencing volatility in the rates markets, as can be seen for an indication from the swap market. That created and still creates opportunities and challenges. The main shift is moving away from passively, investing in traditional instruments such as time deposits, and moving towards more active management, albeit in a really narrow frame for corporates, using alternative instruments. For instance, at the end of 22, 23, and 24, albeit at a lower level, the yield curve was inverted. There was a clear incentive to invest between 0 and 12 months actively. Now the yield curve has normalized. It makes sense to move a bit outwards. But again, active management came as a result of volatility, which in my view, will persist due to the macro and geopolitical environment.
Thank you both of you from your corporate perspective. Now, I'm going to head to the other side. The question is, what consideration determine the balance between holding liquidity in cash reserve versus deploying it in excess funds into short-term investments? I'm starting with you, Daniele.
Yeah, okay. From our experience working with corporate and managing a treasury solution, we can maybe underline 3 points that are important from this view. The first one would be the visibility on the cash need. So we have 3 different types of cash that can be called daily cash, operational cash, and strategic cash. So it will be that are linked to a different investment horizon, 1 day, 1 month, 1 month, 6 months, and more than 6 months. So it will be the first point to take into consideration. The other one will be the kind of internal policy that will be followed by different kind of clients, so internal guideline. And this aspect will have an impact for the couple risk appetite, risk needs, and performance needs. So with respect to this point, we will accompany the clients, the corporate and others, to the best solution that fit in more with this kind of requirements. And the third point will be the cash equivalency. So the fact if a client is obliged or prefer to invest in this kind of products, so will be oriented towards money market funds, or if this is not the requirement, we'll have other solutions like ultra-short term bonds funds.
Thank you. Mark, you're answering the same question.
Yeah, so our clients reflect exactly what Daniel said. The stress test, what is liquidity? Essentially, it's a stress test. So what are the trigger events that will affect your business? Stress test those trigger events, and then compartmentalize those cash into three: operational cash, medium-term cash, strategic cash, and then deploy those cash investments to your risk appetite and to your treasury policy. And that can be, essentially you've got three pillars: capital preservation, liquidity, yield. Still today, capital preservation is number one, liquidity number two. That goes into your stress test environment. And then yield as well, but yield is normally an enhancement for that strategic cash.
So, Daniele, given the current rate environment, how should corporates receive their allocation across money market funds into short duration instruments?
Yeah, but well, we can say that we have a good news, meaning that in our strategy, no matter what rate environment we have, we can say grant instant liquidity with our products. So we have an experience of almost 40 years managing a liquidity solution. So this is the first point we want to respect, we need to respect according to regulation. Then the key word will be diversification. We offer a panel of different products, referring to what I said previously. So the client will choose the best product according to internal guidelines. So we can have products, short-term money market fund and govies, so we know financial exposure, AAA rated short-term money market funds, standard, that will have an additional leeway in terms of investment, so more potential performance. And if there's no need of cash equivalency, product ultra short-term bonds, so with potential performance higher. And then an important point is also the fact that the diversification with our product is created also with the fact that in one single product we can have up to 100 different issuers represented in the portfolio. So two aspects where with what we can create the diversification for our clients.
So, Andreas, from your corporate view, in terms of cash on balance sheet, how you can receive the allocation from short-term investment?
I'm going to broaden the answer to put the answer a bit into perspective. So I will state the obvious, but it's good to keep it in mind that corporate treasuries are not in the business of generating alpha, taking on beta risk via equities, or benchmarking against the cost of equity of shareholders. So that said, for horizons that are up to 1.5 years of duration, maximum 2, there are several possibilities, as mentioned already, that offer pooled investments, well-diversified, actively managed portfolios, which offer the added benefit of quick liquidation and daily mark-to-market. Now, for longer horizons, liquidity, to be justified, has to be tied to an upcoming M&A, CapEx investment, a corporate action, or be the reason of a very negative outlook. Otherwise, it raises a question of exposing shareholders to, opportunity cost. And also, longer horizons, excuse me, have the additional issue of mark-to-market volatility, and possibly, in case of need, liquidation risk. To tie what I mentioned to the graph, the table on the left is a good depiction of the possibilities, excuse me, on the shorter end of the curve. You have time depots, but you also have the repo market, and you have short duration up to 3 or 5 years investment-grade bonds.
So, Yannis, back to you. Are corporate prepared to expand the risk tolerance for higher yield, or does capital preservation remains?
I suppose this depends on the corporate. First of all, I believe that every corporate should, let's say, make its own assessment and decide how much risk they want to take, how much risk they can tolerate. And this has to go across the board to all levels of, let's say, corporate kind of governance. I mean, the board should approve, the audit and risk committee, the executive team, and obviously the whole organization. If you want my opinion, I think that we have the tools to take bigger risk and let's say, enjoy higher yields. I think that, let's say, the asset management has become more and more sophisticated. Also, corporate tools and technology are helping to monitor the risk, let's say, and the performance on a daily basis. And this is quite helpful in order to take, let's say, somehow to take, let's say, the necessary changes and moves in order to protect yourself. I think it's a key sort of characteristic of your, let's say, liquidity management, as Daniele said, is diversification. If you do, let's say, the proper diversification, I think that you are taking calculated risk. Every portfolio, even if it's a high-yield bond, has, let's say, the rate of default calculated, and in that case, you know how much risk you are taking. Of course, as we said before, we are, let's say, living, let's say, lately in a volatile environment. So you have to prepare ourselves, let's say, so for disruptions, and for that, it's let's say, corporations, its corporate should, let's say, plan its liquidity management in a way that can afford, let's say, sort of disruption. So don't stress your balance sheet, don't stress your liquidity. Keep some safety cushions. If something goes wrong or goes south for a period, you should be able, let's say, to afford staying invested or, let's say, do your moves, let's say, without disrupting the operation of the corporate.
That is true. Now I'm going to go to the other side, and the institutional one. So, Mark, the same question.
I mean, in terms of market sentiment, the price of gold's at an all-time high. So the market in general is cautiously optimistic, but at the short end. I would say what's key, because we're in a volatile world right now, either geopolitically, economically, is to have an agile investment policy and strategy so you can move with the market. But generally, the markets, the risk-adjusted returns in the short end are favorable to the longer end. Having said that, especially when we look at the Fed, they're more willing to take growth over inflation. They'll break their inflation targets to spur on that growth right now. So we're seeing a steepening of the curve, the yield curve, in the longer end of the market. So certainly if you want to go long, there's rewards there. But by and large, the market's still short.
That is true. Back to you, Yannis. And what is, from your point of view, the most critical liquidity risk scenarios corporate should take to model today?
Obviously, as we have already discussed, there are, let's say, several uncertainties. There are always been, but maybe the last, let's say, year or maybe a bit more, I mean, all these uncertainties have been, let's say, sort of been more tension, more, let's say, intense. So let's say we have interest rates, let's say, fluctuation. So your stress scenario should take into consideration what happens if rates are going up and down, not only on your liquidity management but also corporate operation. You have significant FX changes. Lately, we have seen in the last few months, let's say, euro-dollar moving, let's say, significantly, let's say, change significantly. I mean, and the other and most important is you have to factor in, let's say, sort of let's say, sort of financial, let's say, risks that are, let's say, affecting obviously the financial markets. So one has to take into account geopolitical tensions, issues like, let's say, the disruption in the logistics that took place during the COVID era. COVID, for example, it was something that, let's say, no one could predict, but let's say you find yourself all of a sudden, let's say, to face issues that you haven't faced. So, and you have to be able, let's say, to meet all, as a corporate, you have to be able to meet all these, let's say, sort of challenges. And sometimes you have to combine, let's say, one or more, let's say, sort of risk factors all together. And I think that this is the change from what we were doing in the past. As I said before also, I think that we have the tools. We have the tools. There are, let's say, liquidity management tools and, let's say, that can, let's say, help you with, let's say, risk scenarios. So you can take the necessary, let's say, actions in order to prevent, let's say, corporate from a kind of challenging, let's say, sort of situations and abrupt the operation of the company.
True. When it comes to risk scenarios, it's always with risk appetite as well through the management.
Obviously.
But Andreas, from your perspective, the risk modeling and how these differ from the past ones due to high volatility?
Well, the environment can be the same, but I'm sorry. A corporate's exposure is highly dependent on its specific circumstances. So it depends on whether it has access to credit, the structure of its balance sheet, the trade-offs between receivables and payables, and the probabilities of getting affected, more heavily on either side from a downturn. FX exposures, rates outlook vis-a-vis liquidity already available in view of net working capital needs and more strategic needs. So it depends. I mean, what is risk for a corporate can be a great opportunity for another. What my perspective is, however, is that from a liquidity management standpoint, the proximity of treasuries to the market and the market awareness that you gain from actively managing can very, nicely fit into the liabilities and hedging side of things to end up in, either a structure or implicit asset liability managed framework, which is very useful and absolutely necessary from a risk management perspective.
So we have the cash flow, we have the stress testing, and eventually we need to have a funding plan. And in the other group, Mark, what are the funding plans that a corporate should have?
First of all, the corporate should have First of all, timely and accurate data, first of all. Then within their frameworks, they can stress test their liquidity needs and their profiles. And then you need the funding plans behind those profiles. Stress tested. Sometimes you'll have credit available, never used. You may have to pay for that, but that's the price of resilience. So really, the funding plans really depend on your risk profile and your frameworks in order to meet those stress tests and the requirements that they produce.
Daniele, from your view?
Yeah, on our side, we can say that with money market fund, we have mandatory stress tests required by regulation. And according to them, we adjust the instant liquidity in portfolios. That to give you an idea, today is around 25% for standard money market fund daily basis, where the percentage of corporate client will be considered as more volatile for our portfolio construction. So another point is we work on the liability basis of clients, so we take into consideration the fact that we prefer to have international distribution, clients coming from different sectors of activity, so institutional, corporate, third-party distribution, to have a more stable evolution of the asset during the life of a fund. Saying that, so our objective is to granting daily liquidity under all markets conditions, in particular taking into consideration the fact that we have very important flows on a daily basis, in and out. They can be higher than 1 billion on a single day on a single funds. So in addition to that, in a money market fund, we have no penalty, no entry or exit fees for the flow we receive.
So we have the corporate view of stress testing, cash flow, and the appetite actually to invest. And from the other ground, we have the funding plan. So the next question goes to all of you. And what is the effective collaboration between the corporate side and the other side, banks and asset managers? So, Andreas, you can start.
In a nutshell, I would say that it helps moving away from a transactional relationship to a partnership, both on the assets and liabilities side, especially for assets and liquidity management. Term depots, in my view, are the bare minimum. There are lots of opportunities in the market, so you expect from banks and asset managers to put in place, to invest in technology, to eliminate operational burden, to offer, real-time valuations, to give you actionable insights, to give you access to data, to be proactive in case of, to give you a heads up in case something is amiss.
Yanis?
I agree. I think that each corporate, the corporate should have, as you said, a clear calculation of the risk tolerance and a very, let's say, sort of solid cash flow and, let's say, liquidity plan. And this has to be communicated with your let's say, partner on the other side of the line, which is the asset manager that you are working, or the bank. And you should, let's say, sit down and see what are the best products and the best allocations you can make in order to serve, let's say, the plan that you have in mind and you have to serve as a corporate. So I think that it's a matter of, let's say, good and open communication from both sides.
And less commission, I will say. Sorry. Now, back to you, Mark.
I agree on the product side, first of all. So is a product fitting the client need? That can be AI, that can be open architecture, it can be integration, or it can be investment products. At Bank of New York, we've started distributing data on-chain. So we have APIs, but it's now using fintech solutions to distribute data. Is that within the risk appetite of the corporates? And that's, I think the second point is communication as well. So we have a volatile market. We have changing economic conditions. So making sure that, again, your risk appetite fits with the wider macroeconomic environment. And again, the asset managers can play a key role in that communication.
Daniele?
On my point of view, you can say that a solution, treasury solution, doesn't exclude the other. So the toolbox of the corporate clients should be composed by money market, bank deposits, repo, direct investment in bonds, for example. The second one is that as Amundi, we have also another side, or the perspective. So we finance corporate, we finance banking sector, invest in the money. We have a money market fund, so we collaborate also in this part of the business. Maybe a third point is that the fact that we try to provide a maximum level of transparency, sending a lot of information about market dynamics to our clients, and also clients have the possibility to have direct access to our portfolio manager to have the good information to better manage their treasury on their side.
Now I'm staying with you, and we have market volatility.
Yep.
And as a corporate, I need to seize an opportunity in periods of market dislocation without compromising my security in operational requirements.
Yeah, what we know is that for our experience with corporate, the most important point in this kind of market is to have the instant cash always available on a daily basis, and the capital conservation on a daily basis as well. So clients doesn't want to have want to know the level of money they can have back when they need the money without any kind of surprise. Then a good approach is the good segmentation of cash. So I can remind the first answer to the question. So the fact that clients should decide what is the best solution according to the internal requirements. And then the fact that investing in money market funds, we are able to reduce at a very low level the volatility that is present in the markets. So investing currently in floating instruments that are linked to the evolution of the money market indexes, so very low level of volatility, or hedging an exposure to fixed term instrument with, for example, interest rate swap.
Now, Yanis, how can corporates seize opportunities?
Listen, I think that, first of all, you have to monitor, let's say, very carefully the market. And at the same time, I think that every, let's say, sort of CFO or treasurer should have, let's say, a view towards the market. Because what we are talking about is market mispricing. So the idea here is how you can take advantage of that, and I think that you can. So in let's say cases of market dislocation, there are opportunities, and you have to capture. This can be on the FX. As I said before, it was obvious a couple of years ago that rates could go down. So if you had excess liquidity for the next 2-3 years, you could lock returns of 3, 4, 5%. 6 in certain cases, like let's say financial ledgers of financial bonds across Europe, and let's say have such kind of return for the next 3-4 years. I think there are still opportunities like that in the market, so you have to let's say close monitor and be able to capture. Again, I agree with Daniele that you always have to have cash buffers in order to be able, let's say, to meet, let's say, sort of fluctuations in the market, and also be able to capture opportunities, because if the market goes down, because I think it's different let's say, the ups and downs of the market that we have the last 5 years, and differently you have, let's say, very short-term volatility. And this can give you opportunity if you take position against the market. This can be, let's say, for, let's say, selling volatility, or, let's say, buying the market when it goes down, and then obviously you take a calculated bet that it will return in a certain area, or you can even, let's say, buy your own liability. Either it's, let's say, a bond that you issue a couple of years ago and with a high coupon, and now market goes down, so you buy back your bond or refinance, obviously, or you buy back your obligation with a discount from your let's say, sort of supplier. So, I mean, if you are, let's say, focused and detailed, I think that you can take you can take advantage of market, let's say, volatility and disruption. Always, of course, the risk should be calculated. That's it.
So, Mark, what short-term opportunity currently exists for the deployment of excess liquidity and the risk we should be considered about?
So yeah, we still see our clients, by and large, staying short, being liquid, and we see risk-adjusted returns in the short end of the curve. So that said, then what risks are there? Essentially, that's credit risk. And what's your risk appetite? So are you happy with this bank at this rating, with this interest rate? Would you like to go into a term deposit? What's your risk appetite? Or indeed, can you go to a money market fund? And the beauty of the money market fund is essentially that credit risk is outsourced to the asset manager. So then you're looking at the credit rating, high credit rating of a fund, and as I say, you've got experts on that credit risk. So do you want to take on that credit risk yourself, make your own assessment, go deploy into a balance sheet, or do you want to go to an off-balance sheet specialized product? And I think that's individual to the corporates and their risk policy.
That is true. What's your view, Andreas?
Before moving to the market side of things, the easier quick win for corporates is usually internally. Unlocking trapped cash, exploring the possibility of intercompany and intergroup financing. At the very extreme, and although this is not a short-term endeavor, they can consider an in-house bank, although the environment, both on the legal and the tax front, are not very favorable or very clear on that. Regarding the market side of things, the second graph to the right shows that there are a number of opportunities on the rates front. Apparently, there's no distinction between, the repo market, Euribor, term deposits, etc. But there is some pickup there you can get, which is around about 50 to 60 basis points. At current levels, this is substantial. It's close to 25% of the level of the rates. Moving rightwards, you have the investment-grade corporate yield curve, which you can capture via funds, which are managed professionally. They're well diversified. It's very hard for a corporate to replicate a fund manager with the pricing power of Amundi, which is, for example, which is managing, I think, hundreds of billions of euros, if not trillions. And a comment about, because you mentioned risk, some products that are very popular nowadays, structured products that are not necessarily linear. They are very useful if you want to diversify your risk profile. However, for a corporate standpoint, they are very hard to explain to a board. And, conceptually, it's a question to answer whether it's up to the corporate to invest in such products on behalf of shareholders and not let them decide, depending their circumstances, their risk appetite, and their sophistication, to invest directly themselves.
So, back to all of you, and I want your 30-second closing statement. So, what single piece of advice would you offer to corporate treasurer managing liquidity at the ending of 2025 and the beginning of 2026? I know the answer is going to be, we don't know. The couple of years shows that, but what's your view? Starting with you, Daniele.
I will be shorter than 30 seconds. I think that the key word will be the diversification, and the corporate side having a toolbox, a different solution, including money market funds.
Perfect. From you, Mark?
My word is resilience. According to the World Economic Forum, cybercrime is the third biggest economy in the world, behind USA and China, and it's growing. We have geopolitical headwinds, market volatility, AI coming through, digital assets. So be resilient within the operating model, within your supply chain and your counterparties, and especially within your liquidity strategy.
So from the corporate view, Yanis?
Yeah, I would say have your plan well calculated, be diversified, and also have always room for further liquidity and, let's say, flexibility. Don't stress your liquidity plan and your balance sheet.
And at the end, Andreas?
I would say create a framework. I don't know what the future brings, but you have to be prepared. So I would say create a framework for the CFO and the CEO to have clarity, a framework that you have to own, adjust, and implement to balance liquidity with opportunity and risk.
That is true. We need to have a long-term view. We need to have diversification, as you said, Daniele. And we need to, both of us, I mean the corporates and you, to be closer when it comes to collaboration and information. So that was it. I want to thank, of course, you. Thank you to be here today. And I want to thank all of you that you're here and watching. Thank you.